Namaste, my dear friends. In the last class, we referred by discussing elaborately the concept of export procedure under the customs. Now I am referring import procedure under the customs. When the vessel arrives Indian port, the master of the vessel, who is the person in charge, should submit arrival manifest. What is it is? Nothing but, in the last class we referred, departure manifest from the exporter country point of view. The same copy without any modification alterations from the importer country point of view, we used to call it as arrival manifest. And the person in charge, in our given example, master of the vessel, should submit arrival manifest through online in the office of the Department of Customs. Customs authorities will verify what type of goods brought into India. Is it prohibited goods? Is it restricted goods? Is it general goods? General goods. Assume wearing apparel, cloth. Then the Department of Customs will grant the permission. Entry inward granted. Entry inward granted to the conveyance. Conveyance which includes vessel in our given example. Entry inwards granted to the conveyance, to the vessel. Thereafter, unloading of the goods takes place. After that only unloading of the goods takes place. If the unloading has been taken place, ultimate destination in India, in Indian port, the importer who claiming the ownership on that imported goods should submit bill of entry. I am talking about bill of entry, which is a documents of title in the hands of the importer to prove his ownership on the imported goods. How it has been prepared? It has been prepared by using the CBIC portal, where there is a customs sub portal. In that, if you go, there is a bill of entry that you have to fill up based on the information which the importer received from the exporter. 1. Export invoice. 2. Packing list. 3. Bill of lading copy. This information should be furnished in the bill of lading, I mean to say in the bill of entry. Apart from that, in the bill of entry, the importer should arrive the value of imported goods, which is called as self-assessment. And not only the value of imported goods, which is subject to import duty, also be compute duties on imported goods, basic custom duty, in short BCD, social welfare surcharge on BCD, namely SWS. Further, IGST, namely additional customs duty, which is par with the IGST rate applicable for the given port in India. And further any other duties like safeguard duty or the anti-dumping duty. If these duties are there, means IGST will be computed by adding all these particular custom duties. Once you compute the duties shown in the bill of entry, have you wanted to clear the goods immediately? You want for home consumption? Yes, sir. In that case, file the white color bill of entry. you file the white color bill of entry, which denotes goods cleared for home consumption. The department of question verify that, your assessment is perfectly correct. Your computation of duties also be perfectly correct. Take the bill of entry, pay the duty. Under the customs law, unlike of the GST law, there is no specific due dates to pay the duty. The moment the bill of entry returned to you, on the same day you have to pay the duty. If you pay next day, then the day on which you not paid, and the next day, 2 days delay. Of course, if any holidays in between, that can be reduces. The rate of interest for delay payment of custom duty under the customs law only 15%, 1-5. There is no 18% GST. There is no 24% per annum. There is no 18% IGST. There is no 24% IGST. 24% of interest. There is no 18% of interest, 24% of interest. Unlike of customs, unlike of our GST. Under the customs law, only one slab rate, 15% per annum interest you have to pay. The day on which the bill of it returned to you to pay the duty, the same day you have to pay the duty. If delay happened, so many number of days minus holidays. For the balance number of days, you have to pay interest at the rate of 15% per annum under the customs law. Only one rate, unlike of GST. There is no 18% interest. There is no 24% interest under the customs. Sir, I want to file yellow color bill of entry, which denotes you wanted to clear the goods for warehousing. If the goods are warehouse, then you can defer your import duty into the future period. In that case, you rightly said, submit the yellow color bill of entry. Yellow color bill of entry, where you have to arrive the value of imported goods and the duty arrive thereon, but not required to pay since you are warehousing that particular goods. If the goods are warehoused, the liability to pay the custom duty arises only when you are going to clear the goods from the warehouse for home consumption. That time only you are liable to pay import duty. In that case, for the first 90 days from the date of warehousing, there won't be any interest. Beyond 90 days, you warehouse the goods. From 91 day till the date of clearances, you are liable for interest on the duty which is not paid. Now you are going to pay after 90 days from the date of warehousing, then at the rate of 15% interest per annum from 91 day till the date of clearances, you have to pay custom duty, along with that 15% interest. This is what the chart I mentioned here. Goods cleared for home consumption by submission of white color bill of entry. Goods cleared for warehousing. From warehousing, the goods subsequently cleared for home consumption. Now coming to, in nutshell, import procedure. When you refer here, I mentioned this procedure. Dear friends, this procedure is also be there in our multiple choice questions in the workbook. They have given the combinations. In that, this particular flow of combination 1 to 7 is one of the answer. Vessel arrives at custom station. Because why I am referring the vessel means our maximum import or exports routed through sea in a vessel. Why? The sea freight far cheaper than that of our air freight. We are too having export or import by air, but that air cargo freight is so expensive. Now, therefore, I used to refer vessel as a movement of the goods, conveyance, import or export, more and more takes place through sea in a vessel. That's why I'm referring the vessel concept here. Vessel arrives at custom station. Yes. Master of the vessel should have submit arrival manifest. We know that. Grant of entry inwards to the vessel. by the Department of Customs. If granted, then only unloading of the goods can be takes place. Importer should submit or file bill of entry, obviously, which is importer should submit bill of entry. What is the bill of entry? Documents of title, which shows the ownership in the hands of importer on the goods which is lying on the docks after importation. Assessment of the goods means self-assessment, including duty arrival, payment of duty. If you want to clear the goods for home consumption by submission of white color bill of entry, pay the duty which is mentioned in the bill of entry. Once satisfy the department and return back to you bill of entry by saying that to pay the duty, then you have to pay on the same day. If you pay the duty, you will get an out of customs charge order. Out of customs charge order that you can show at the customs to the custom officers as well as in charge of the vessel, and lift that goods from the customs, load into the truck, and the truck can be carry the goods, bring into India. Once you cross the customs frontier of India, namely it's simple to say check post, then I can say that import is completed. After crossing the customs frontier, if the goods are bringing into India, namely to DTA, these goods no longer called as imported goods. Why? Imported goods means the goods on which the Department of Customs has the control. If I pay the duty and clear the goods for my home consumption, India is my country to consume in my country called home consumption. It is not that to consume in my house. India is my home country to consume in India. If I clear the goods by payment of duty, then brought into my factory or to my premises, it is no longer called imported goods. Up to this, any doubt, my dear friends, of my discussion? Fine. With regard to import procedure, it is not that much of a simplified manner to present in 7 points. When we talk about submission of bill of entry, arrival of value of imported goods, and computation of custom duties. These two are two big chapters. Valuation followed by types of duties and computation. The two chapters are involved. If that you understand, then only you can submit bill of entry by incorporating the value of imported goods correctly. To note value of imported goods, to identify the value of imported goods, we are bound to follow customs valuation, open the bracket, determination of value of imported goods, close the bracket, rules, 2007 as amended up to the Finance Act 2023. We have almost all in that 13 rules we have 13. I am going to present that in a simplified manner. First and foremost, one should understand how to arrive the value of imported goods. Refer the valuation rules. Under the valuation rules, we have the first and foremost rule number 3, transaction value of imported goods. What do you mean by transaction value of imported goods? If the exporter, importer, non-related parties, non-relatives, and the price has sole consideration, The importer not going to be shared with the exporter. After importation, sale proceeds in India not going to share with the exporter. In that case, the price mentioned in the export invoice will be considered as a fair valuation. As I told you in the last class, two important points. One, free on board, point number one. What do you mean by free on board? You are very much aware of now. Otherwise, refer the previous class. I too referred CIF value. Dear friends, we have a basic concept in our foreign trade policy because advanced concept of customs law is none other than is a foreign trade policy. Now, here all our exports is measuring with free on board. All our imports we used to measure with CIF value. Meaning, when export takes place, customs duty, if any, levied on FOB. Duty drawback, DDB. If you want to claim, apply on that your FOB value. On account of export, you are claiming duty drawback. Duty of customs, if any levied, that can be levied on FOB value of export. That means all our exports we are measuring at FOB value. All our imports we used to measure at CIF value if there is customs duty measured on CIF value, duty of customs. That means this is known as assessable value, value subject to custom duty in case of import. All our imports are measured at CIF value, all our exports are measured at FOB value. It's a basic concept. When we talk about value of import, the import valuation for our custom duty purpose is at CIF value. All our imports undoubtedly subject to import duty, that you should understand, except there is specific notification which provide exemption is in force at the time of import. In a simple terminology to say, my dear friends, when we talk about import, I said first and foremost, rule number 3, transaction value of imported goods. The value which is at a CIF value, then the value of import itself is the assessable value. No, sir, the value which is imported at a FOB price, sir. If it is FOB price, two things are required here. If the goods are imported at FOB value, free on board. What do you mean by free on board? You are very much aware of that. All expenditure incurred by the importer, I mean to say all expenditure incurred by the exporter up to the point of loading the goods on board into the vessel is incurred by the exporter. Therefore, from the importer point of view, till the time of expenditure, importer not incurred, from the importer point of view, it is called as free on board. The moment that goods reaches to the importer country port or airport or the land port, that importer has to make the payment to that particular goods, then FOB become cost. Now, FOB is given, for example, which is in USD, let's say $1 lakh. Since is import, I want import of goods. Of course, goods only. Import of goods. If there is no import of goods, export of goods, my dear, there is no customs law. Need to refer. What for we refer? Only when the goods are imported into India, goods are exported outside India, then only the customs has importance. Otherwise, customs has no importance. So, import of goods at FOB value, since our import we should measure at CIF value. In the given case, CIF value not given, we have to develop to the CIF value. How? Take the help of rule number 10. Rule number 10. Don't worry at all. You will get it by way of a flow. What is the rule number 10? Cost of service. What is it is? All expenditure incurred up to the point of importation as a pre-shipment expenditure add in the value of imported goods. It should be pre-shipment expenditure. It should not be post-shipment expenditure. If the post-shipment expenditure that is not relevant to add in the value of imported goods to arrive the CIF value. What do you mean this, sir? The post-shipment, pre-shipment. Assume a scenario. A vessel carrying the goods, these goods landed on the landmass of India. Unloading taken place. The moment the goods landed on the landmass of India, up to that point of time, expenditure is called as pre-shipment expenditure. After landing the goods on the landmass of India, expenditure incurred is post-shipment expenditure. Technically, simplified manner I am presenting. Ship demurrages and port demurrages. There are two types of demurrages. Ship demurrages, port demurrages. When the vessel reaches to any nearby port in India, halted outer anchorage away from the port. When this vessel obtain the permission to halt, means there must be nearby the port berth to halt the vessel. Already there are so many vessels occupy the port. A vessel coming from South Africa to Chennai port halted outer anchorage, waiting for the want of berth place. Traffic jam. Sir, what you are telling, coastal area, so much of a wider one, open area, how it's possible of a traffic jam, sir? Yes. If the vessel reaches to any other place other than the designated area of halt nearby port, what is going to happen now? Due to the overweight of that particular vessel, it may stuck into sand. Once it stuck into sand, you and me cannot go and pull. Bahubali 1, Bahubali 2 also not possible to pull. If you pull means that vessel will break. Understand here concept. When coastal areas are so wider for us, India, one side Bay of Bengal, other side Indian Ocean, another side Arabian Sea, such a coastal area we have. But We have designated major ports. Mumbai, one of the major port. Cochin, major port. Chennai, major port. Vizag, major port. Paradip, major port. So these and all major ports were designated nearby that coastal area, my dear friends. The depth of the sea is too huge. The vessel smoothly can sail. If the depth of the sea is reduces due to the overweight of the vessel, it may stuck into the sand nearby coastal area. That is the reason the vessel is halted at outer anchorage, not able to come nearby the port. If we refer here, take southern India, here Chennai port, here is a vessel halted for the want of a particular what we can call it birthplace. Almost 10 days are over. After that, the vessel got birthplace and it further reaches to port, nearby port, and unloading of the goods taken place. 10 days delay to unload the goods at the Indian port. Shipper company says, "Hey, Mr. Importer, because of you only we came to the Chennai port. Inordinate delay taken place here. Accordingly, further our scheduled delivery in other places also will get delay. Therefore, you please pay to us some compensation." That is called as ship demurrages. The goods now landed on landmass of India, where on port, jetty we used to call. Port or the jetty we used to call. Where generally allowed to store the goods on dock, on port for a maximum of 3 days. Beyond 3 days, if we kept on the docks, further movement of the goods will get inconvenient. Then the Port Trust Authority of India will charge port demurrages on such goods which you not cleared in time. Now, you came to know what is ship demurrages, what is port demurrages. I said rule number 10 refers all expenditure, cost of services relating to import, pre-shipment expenditure should add, post-shipment expenditure should not be added. Correct, my dear? If that is the case, can you tell me ship demurrages, post-shipment, pre-shipment, ship demurrages? Perfect, excellent. Therefore, will form part of the rule number 10 to add in the value of FOB to get CIF value. 1 point. Second point, port demurrages. Port demurrages. Is it pre-shipment or post-shipment? Port demurrages. Post-shipment. After landing the goods on the landmass of India, any expenditure relating to that particular goods is called as post-shipment expenditure. Warehousing charges after importing the goods, goods are warehoused. Warehousing charges, post-shipment or pre-shipment? Post-shipment. From the port to the factory, transit insurance, freight, post-shipment or pre-shipment? Which is addable, not addable? Not addable. As simple as that. As simple as that. But for the given statement, we have one exception. If the post-shipment expenditure is a precondition to import. Sometimes buyer is to say, importer is to say, "Hey, Mr. Exporter, seller, I want your product to install in my factory in India I mean door delivery. I want door delivery. What is the amount of the product? That time the post shipment is adding by the exporter and charging to the importer. In that case, such a post shipment, which is a precondition to import, in that case, that post shipment expenditure is form part of the value of imported goods to pay the import duty. Now come back. What I explained to you so far, rule number 10. What is rule number 10? Which is cost of services. Which cost of service we are talking here? Pre-shipment cost of services. That only should be added. Post-shipment not addable. Exception we have separately. So the meaning of rule number 10 only explained so far for a kind consideration. Now, actually my target what? Value of imported goods. All our imports should be measured at CF value. If so, I should arrive the CF value. If I want to arrive the CF value, where the import is FOB value, I have to take the help of rule number 10, where rule number 10, sub number 2, very clearly says, add to the FOB value insurance. Sir, insurance not known, sir. What insurance? From the exporter country port to the importer country port, transit insurance, transit loss insurance. That I do not know, sir. In that case, rule number 10, sub number 2 says that if not known cases, insurance at the rate of 1.125%, 1.125% on FOB value of customs. So, Department of Customs consider this as a FOB value. Department of Customs consider this FOB value. FOB value of exporter, here no other information is there. Therefore, it becomes FOB value of customs. In that case, 1% on such 1.125%, 1.125% on 1 lakh, which comes 1,000. 125, correct, sir? 1,125 on 1 lakh, 1.125%, 1,125. We got insurance with the help of rule number 10. From rule number 10 only, we got this percentage, 1.125%. Freight, not known. Which freight? From exporter country port to the importer country port, sea freight, not known. Therefore, we should know by rule number 10 is available in percentage freight, which is at the rate of 20%, again on FOB value of what? Of customs. 20% from rule number 10 on FOB value 1 lakh, which is 20,000. Then arrive the value, which is 1 lakh 21,125 which is called what? Here I is there, I. Here F is there, F. Then FOB become cost to the importer when the import goods takes place. Then C. FOB means cost to the importer. Insurance, freight. So we arrive the CIF value 1,21,125. So far so good. Now my dear friends, if there is a case, can I pay import duty on that? Sorry, the given value is in US dollars. You have to convert this into Indian rupees. It should be converted into Indian rupees by multiplying with exchange rate. Which exchange rate should be considered? Reserve Bank of India exchange rate, actual payment made to the exporter by the importer, that rate, or LIBOR, Indian the London Interbank Offer rate, or is Government of India exchange rate, or Central Board of Indirect Taxes and Customs exchange rate. The law here very clearly says that it should be as per the Central Board of Indirect Tax and Customs, CBIC exchange rate. CBIC, we used to declare exchange rate monthly once, import or export. CBIC exchange rate. Now, if two or more exchange rate of the CBIC is available, then at the time of the importer going to submit bill of entry, at the time of submission of bill of entry, the exchange rate of the CBIC is relevant if there is more than one exchange rate of the CBIC. Sir, in a given problem, there is LIBOR, London Interbank Offer rate is there, sir. Actual exchange rate through bank paid to exporter by importer is available, sir. Government of India exchange rate is available, sir. Reserve Bank of India exchange rate is available, sir. But what you said, CBIC exchange rate itself not given, sir. In that case, on what should I refer, sir? If the CBIC exchange rate is not available, please ensure that whether the Government of India exchange rate is given. Government of India exchange is given, sir. That is what? No, CBIC. CBIC is not a separate private company. CBIC is none other than the government. Therefore, the government exchange rate should be considered. I came to know that the exchange rate of the CBIC is, let us say, at the rate of 89 rupees per USD. Per USD. In that case, you multiply it. 1,21,125 multiply by 89. Then you will get Indian rupees. CIF value, Indian rupees. 1,07,80,125. This is what the assembly value. This is what assembly value. If there is basic custom duty, which is levied as per section 12 of the Customs Act, basic custom duty, which rate should be considered? There are two or more basic custom duties are available on two or more dates. Here the topic will come into picture. Taxable event. Taxable event for imported goods. As per the Gordon Silk Mills Limited of the Supreme Court of India. Supreme Court of India said taxable event for imported goods is at the time of crossing customs frontier of India. Customs frontier of India. What do you mean this? Check post. When the goods are imported, bringing that goods from the port to India, there is a customs check post. Verified. Have you paid import duty? You carrying the right goods, the goods available in the bill of entry, same goods available in the truck, fine. Then chhod de rahe, allowed to leave. The vehicle come into the India, means crossing the customs area. That point is called as customs frontier. As per the Gordon Silk Mills Limited, crossing the customs frontier of India is called as the taxable event. If that is the case, we can simplify it in the following manner. Taxable event here. date of submission of BE. BE means bill of entry. One date. Two, date of submission of bill of entry or date of entry inwards granted to the conveyance. Among the two dates, whichever date happens to be happen later, means other one takes place. Whichever is later, date of submission of bill of entry or date of entry inward, whichever is later, within whichever is later, as on that date, what is the rate of duty that is applicable here? For example, date of submission of bill of entry, let us say for example 15th March 2024. Date of entry inwards granted, let us say 18th March 2024. Whichever is later, 18th March 2024. Suppose for example, in a case in the typical situation here, basic custom duty 12%, BCD is 12%. As on this date, BCD for example revised to 8% here. So taxable event when you come into picture, date of submission of bill of entry, which is 15th March 2024, is 12%. As on the date of submission of bill of entry, 12%. Date of entry inwards granted, as on that date, rate of BCD 8%. Whichever is later, 18th March is later. What rate of BCD? 8%. In that case, basic custom duty applicable on this value is 8%. 8% on this 1 crore 7 lakh 80,125 is nothing but here 8 lakh 62,410. 8 lakh 62,410. If the BCD comes, automatically for all our imports, wherever the BCD, then social welfare surcharge is automatic, which is standard 10% on basic custom duty, which is 86,241. I think you are getting me. Then you have to arrive the subtotal here. Here 1 crore 7 lakh 80,125 plus 8 lakh 62,410 plus social welfare charges 86,241. You will get here almost all 1 crore 17 lakhs 28,776. If no other duties apart from BCD and IGST, then this is called as transaction value. You know, transaction value, sometimes before the GST law we come across valuation, section 15 of the CGST. Section 15, subsection 1, subsection 2, class A to class E we referred, and we finally said transaction value, the value subject to GST. So here, when we talk about IGST, which is as per section 3, subsection 7 of the Customs Tariff Act 1975, technically it is called additional custom duty, which is in addition to the basic custom duty. If so, such additional custom duty none other than IGST. that IGST is none other than the IGST available for the given product in India. Instead of importing, if I procured in India, what rate of IGST for the given product that is applicable for import of goods of same rate. Sir, what about if I purchase locally in India, the IGST nil? Is it so? Yes, sir. Here also IGST nil. Sir, 18% of IGST, sir. The product available in the Indian market, that product I imported, sir. Pay the same IGST 18% here. So, for example, 18% of the IGST on what value? On transaction value. The value includes duties. Yes, as per section 15, subsection 2, class A of the CGST Act, where all duties and taxes should be added in the transaction value to levy the GST, except GST taxes. You are aware of that. That time, whenever property tax, cess, that and this. So, 80% of IGST on the transaction value 1 crore 17 lakh 28,776. For example, in the given case is 18%. If there is a case here 21 lakh 11,180, round off, then arrive the value 1 crore 17 lakhs 28,776. Add IGST 21 lakh 11,180, which is equal to 1 crore 38 lakhs 39,956. This is the landed value. Why I refer so much means, in your bill of entry, you have to show assumed value, which is safe value. How much? Means you got here USD. This is your USD, correct? That USD copy and paste CF value you have to show in USD. Not only that, my dear, you have to show CF value Indian rupees, which is nothing but transaction value. Sorry to say here. CF value means this one. Indian rupees. 1 crore 7 lakh 80,125, which is your CF value Indian rupees. Thereafter, you have to show, after this, you have to say BCD, SWS, IGST. Simple. Copying here, same values should be shown in the bill of entry. Thereafter, IGST. Now, if you submit like this, your bill of entry, department verifies. Assessment is correct. Okay. Computation of duty is correct. So, assessment correct. BCD, SWS, IGST correct. Hey, Mr. Importer, clear the bill of entry, pay import duty. You want to clear the goods? No, for home consumption. That's why you submit the vertical bill of entry. So, bill of entry returned. When? Today. If today returned, today itself you have to pay the duty. If you paid next week of the same date means so many number of days minus holidays. The balance number of days you have to pay on the duty interest at the rate of 15% per annum. 15% is per annum. So far I referred what? From one angle, submission of bill of entry for home consumption when the goods import takes place. At this point of time, I am going to bring to a notice one numeric problem in this regard, which was appeared CMA final. One can expect in the CF final also. Reading this example, even from the handbook itself, is available, page number 492. One example. Now I am referring here. Reading as follows. A bill of entry was presented on 4th August. The vessel carrying the goods arrived on 11th August. Entry inwards granted on 13th August, and the bill of entry was assessed on that date and was also returned to the importer for payment of duty on that day. The duty amounting to 5 lakh rupees was paid by the importer on 22nd August. Calculate the amount of interest payable under section 47, subsection 2 of the Customs Act 1962, given that there were 4 holidays during the period from 14th August to 22nd August. How we can able to identify the solution for this? Dear friends, it is a case where you not paid the import duty the date on which they returned the bill of entry to pay. Delay happened. Total number of days, how many? Should not be count from 14th August. Should not count from 14th August. Reason, they returned the bill of entry when? Here they said, thereafter here, the bill of entry was assessed on the date and was also returned to the importer for payment of duty on the date, means on 13th August. 13th August when they returned, that date also one day. 13th August, one day. 13, 14th, 15, 16, 17, 18, 19, 20, 21, 22. Totally 10 days are here. 10 days. 10 days minus holidays. How many holidays they said in the given problem? They have given 4 holidays. If so, 10 minus 4, 6. For the 6 days interest here on 5 lakh rupees. Rate of interest 15% per annum under customs for 6 days divided by 365 days. How much comes it is? 5 lakh, 15% for 6 days divided by 365 days, which is almost all. Work out here 1,233 rupees interest liable to pay. This is a CMA final problem. One can expect in the exam of CF final also. Now please come back. Actually, where we are? We are import procedure, where I said in the case of import procedure, my dear, here it is not that much of simple. When I say file the bill of entry, to file the bill of entry, I should have to prepare the value of imported goods by following the valuation rules. In that, I refer only rule number 3, transaction value of imported goods. If the value of import itself is acceptable, but the value is at FOB value, all our imports are measuring at CF value. Therefore, I taken the help of rule number 10 to add pre-shipment expenditure, namely freight and insurance, to arrive CIF value which is the value on which we are able to pay import duty, which is denominated in the foreign currency. Therefore, we convert into Indian rupees by multiplying with the exchange rate of the CBSE at the time of submission of the bill of entry. And thereafter, we want to know the taxable event for imported goods. For the taxable event for imported goods, we want to know, for which we taken the help of Garden Silk Mills Limited case, where at the time of crossing the custom frontier of India is the taxable event for imported goods. If that is the case, my dear friends, what is it is? The goods are coming to the point of check post, means there must be submission of bill of entry should take place, and also entry inwards granted to the conveyance also should be taken place. Both the things should be taken place, then only the goods will reach to the customs barrier. In that case, at that moment, checking takes place. The same goods what you imported shown in the bill of entry is available in the truck or not. Once they satisfied, they will allow you to take away the goods. That is called taxable event for imported goods. If so, I simplified by saying that bill of entry submission date or entry inwards granted to the conveyance. Among the two dates, whichever is later, that date, what is the BCD, is applicable to apply on imported goods when the goods are cleared for home consumption. In the given case, I said no, date of bill of entry, date of entry inwards, among the two, whichever is later. Here in the given case, 18th March is later, that date is up, that date rate of duty is applied, is a taxable event. So there is much confusion going to come in the examination by giving the two more different BCDs. You have to apply correctly date of entry inwards granted, date of bill of entry submission. Among the two, whichever is later, that date BCD should be considered. With regard to exchange rate, don't get any confusion. Only the exchange rate of our CBIC should be considered. More than one exchange rate of the CBIC is available. You take the exchange rate of the CBIC at the time of submission of bill of entry. The exchange rate of the CBIC is relevant. Got the clarity, my dear friends? Any doubt? Any doubt? Fine. So further continuation from here. Rule number 4 of valuation rules for imported goods. Transaction value of identical goods. That is important to note. Transaction value of identical goods. Meaning what? In the sense to say that Rule number 4, transaction value of identical goods. Identical. Whose identical goods you are referring here? Exporter country, exporter identical goods. If the transaction value, rule number 3, not feasible to apply. If I am importing goods from Thailand from Mr. Jock. Jock is a supplier from Thailand. I am the importer. I am C Limited of Chennai. If transaction value not applicable, rule number 3, transaction value of identical goods. Mr. Jock, who is supplier of the goods in Thailand, what is his identical goods the price? If not available, some other manufacturers of Thailand manufacturing the identical goods, that price will be the base. If not, rule number 5, similar goods of exporter country of exporter. If not, some other manufacturers manufacture similar goods of the exporter country, that will be the base. If that is also be not available, then rule number 4 not applicable, rule number 5 not applicable, then go to rule number 7, says rule number 5. Directive rule it is. Here I would like to bring to notice one important examination question here. in this given case as follows. In our workbook, I am bringing a problem here. This gives the clarity. Reading as follows. Gujarat Dry Fruits Limited imported dry fruits and declared the value as under. Date of import November, quantity metric ton 250, declared tariff, declared value per metric ton 25,000 rupees, country of import Egypt. November, quantity imported 150, declared value of per metric ton 25,000, country of import Egypt. It was found that imports were also made by the other dealers as indicated below. Date of imports and importer September, Mumbai International imported metric ton 50, declared value per metric ton 35,000 rupees. Country of import Dubai. November month importer imported 50 metric tons, declared value per metric ton 40,000. Country of import Persia. The Custom Department has sought to assess the imports made by the Gujarat Dry Fruits as contemporaneous import under section 14, read with rule number 4 of the Customs Valuation Rules 2007, briefly examined with the action passed by the department is correct. Here, my dear friends, department officer says the goods which you imported at 25 rupees per metric ton is far lesser price because we are comparing the price of the similar product added goods at 35-40,000. Therefore, identical goods we are not going to consider. We will take that identical goods into account. 35 rupees per metric ton from Dubai and Persia 40,000. That will be considered here as your import value. Is the right approach? Why not? Yeah, that's what country of import. Identical goods of whom? Exporter country, exporter, identical goods. If not available, some other manufacturer of the exporter country, Egypt. Other manufacturer of the identical goods should be considered. You cannot take the Dubai, Persia as the identical goods. The department action is not correct in the given case. Now, sir, if the valuation takes place as per the rule number 4, how can be valued? Arrive the value. I will tell you the solution for the given case, how to arrive the value as per the identical goods. Here, when we talk about identical goods, valuation, I will take up directly with the help of an examination problem in this regard to make you understand the rule number 4 concept. Identical goods, rule number 4. Exporter country, exporter, identical goods only relevant. If not, exporter country, other manufacturer who manufacture the identical goods of the same country of exporter, somebody else should be considered. You cannot take identical goods of some other country, of some other manufacturers. Examination problem it is, reading as follows. Malaysian company donated 1,000 metric tons of palm oil to a charitable trust in India for free distribution to the poor and the needy citizens. The trust in India had to meet the expenditure towards freight and insurance only, which comes to $20 per metric ton. The Customs Department found that at or about the same time of importation of this consignment, there were following imports of palm oil or Malaysian origin into India. Quantity imported in metric ton 500, 900, 780 per unit, namely per metric ton. USD CAF value 400, 350, 300 respectively. The rate of exchange on the relevant date was $1 equal to 65 and the rate of custom duty was 20% at 12 RM. Calculate the amount of custom duty payable on the consignment under the Customs Act 1962 with appropriate assumptions and explanations. It found to be sufficient if only basic custom duty is calculated. So, in the given case, how we should be able to answer the solution? See, purpose of import immaterial under the customs law. Unless there is an exemption notification which is in place, you are bound to pay duty applicable on that imported goods. All our imports subject to import duty, as I told you earlier, unless there is an exemption notification which is in place. Now, 1000 metric tons has been imported, edible oil, palm oil is our quantity. Now, nearest quantity of our import, which quantity here you can consider? One is 900, other one is 780, correct? Is the nearest quantity to of our import. There are two prices. One is 350, other one is 200. Among these two prices, which is the lower price, 300, is to be selected. How can you say like this, sir? Refer the rule number 4 of the valuation rules for imported goods. Whichever is lower will be the consideration. In the given case, 300 rupees is to be selected. 300 not rupees, US dollars, which is CAF value directly given. Therefore, my CAF value is equal to 1000 metric tons multiplied by USD 300. I will get here USD 3 lakh. If so, they give an exchange rate 65 rupees multiplied by 65, meaning thereby 3 lakh into 65 is equal to 1 crore 95 lakhs. CAF value in Indian rupees 1 crore 95 lakhs. Then apply basic custom duty given here 20%. So, only BCD is sufficient to calculate 20% on 1 crore 95 lakhs, which is 39 lakhs, is the way in which you can find out the value for identical goods. Again, require practice, memory recall in the examination. Same way, the similar goods, if the identical goods of the exporter not available, some other manufacturer of the exporter country of the exporter not available, then similar goods of the exporter. Similar goods of the exporter not available, some other manufacturer of the same exporter country, similar goods should be considered. If that is also not available, then go to rule number 7, which talks about deductive value. Rule number 7 talks about deductive value. What is to be deducted from what? The deductive value method, my dear friends, is applicable whole good only when it is relating to what we can call here high seas purchases or high seas sale. Rule number 7, deductive value is whole good when the especially high seas sale comes into picture. You are aware of that. Up to 12 nautical miles from the baseline is India. from the baseline to 24 nautical miles, where first 12 nautical miles is India, Indian territory. Thereafter, leftover 24 nautical miles is called as the Indian customs waters. Then from 24 nautical miles from the baseline to 200 nautical miles from the baseline is called as exclusive economic zone. Continental shelf. How exactly to decide India, Indian customs waters, continental shelf, exclusive economic zone? One should know. I have given here definition for that. In your material is the fundamentals. In the page number 453 of yours, he is here. Baseline, coastal area is this. Coastal area. This particular line is called coastal area. From that 12 nautical miles is called India, namely called as territorial waters, also be called India. Thereafter, further 12 nautical miles, contiguous zone. Strictly speaks, from the baseline, it is 24 nautical miles. First 12 nautical miles, territorial waters, India. Thereafter 12 nautical miles, contiguous zone. From 24th nautical mile to 200 nautical mile, from 12th nautical mile is called as here continental shelf. From the 12th nautical mile to 200 nautical miles from the baseline. The 200 nautical miles is from the baseline. Beyond 12 nautical miles, but 200 nautical miles from the baseline is called continental shelf. Beyond 24 nautical miles from the baseline, but within 200 nautical miles from the particular 12th nautical mile is called as here is a 24th nautical mile from the baseline. From here to here is called as exclusive economic zone, namely beyond 24 nautical miles from the baseline, within 200 nautical miles from the baseline. That area is called as this 200 nautical miles computed from here, which has been broken. First part 12 nautical miles, territorial waters. Thereafter 12 nautical miles, contiguous zone. Thereafter the balance, how much? Almost all. If you 200 minus 24, you will get here 176 nautical miles. This area is called exclusive economic zone. Continental shelf here, which is from the baseline to 200 nautical miles, where up to 12 nautical miles India. Therefore, 188 nautical miles from the 12th nautical mile from baseline is called continental shelf. Why I refer so much? Up to this, up to this scale, up to this area we used to call it as exclusive, Indian territorial waters. Indian territorial waters. Indian territorial waters. Up to this. Not Indian territorial waters, speaks deemed territory of India. Better to say. Indian territorial waters, undoubtedly first 12 nautical miles. Thereafter 12 nautical miles is contiguous zone. Thereafter 176 nautical miles continuation is exclusive economic zone. From territorial waters to 200 nautical miles is continental shelf. So as a whole I can say Up to this particular point, I used to say deemed territory of India. The entire thing from the baseline to 200 nautical miles is called as deemed territory of India. Deemed territory, meaning thereby, if I have here oil rig in the exclusive economic zone, I have here a particular oil rig. Assume is oil rig. Where it is located? Oil rig. This oil rig is located within the 200 nautical miles. Now, I purchase the product from outside India, from USA. A vessel sailing from USA and came to oil rig where the goods has been unloaded and got consumed. Liable to pay import duty or not? The importer says India means up to 200 nautical miles, up to 12 nautical miles. India means up to 12 nautical miles only, which is called territorial waters, which is called India. But I am beyond the territorial nautical miles, therefore beyond 12 nautical miles, beyond India. Hence, the oil rig what I import from outside India got consumed, not liable to pay import duty set by the importer. Got dispute from the department and taxpayer, importer. Both of them, by disputing with each other, the matter reaches to the Supreme Court of India. In the case of Aban Lloyd Chillis offshore case, where the Supreme Court of India said, hey Mr. Importer, when you are having the oil rig within 200 nautical miles, if you have within this particular limit, this particular oil rig, we used to call it is deemed territory of India. Undoubtedly, India means first 12 nautical miles is India. But up to 200 nautical miles, we used to call deemed territory of India. As a result, the goods consumed at oil rig is import, liable to pay import duty. Judgment given by the Supreme Court of India in the case of Aban Lloyd Chillis offshore case in favor of department. So why I refer this point here means, now my discussion here is rule number 7. Rule number 7 is what? Deductive value. In the case of deductive value, my dear, this whole good, rule number 7 is whole good only when there is a high sea purchases. What is high sea? Is beyond 200 nautical miles from the baseline is high sea, which is a common area, belongs to all countries. They have equal rights. So, if I have the oil rig in our given example, for example, in the same what I presented no more for your kind consideration, the term India expression is given to you. Let us look into that particular topic here. This is high seas. If I have oil rig, here it is their oil rig, which is where the oil rig is there, beyond 200 miles, high seas. There I extract the mineral or oil, natural gas. My name is ONGC. I am extracting natural resources at high seas and bringing to India to sell. In that case, import, liable to pay import duty. Country of origin not there. Then in that case, selling price India is available? Yes, sir. From that deduct post shipment expenditure. Then you will get assembly value. So what is to deduct from what? Rule number 7, deductive value. Selling price in India less post shipment expenditure. The balance is the value of imported goods to pay the import duty. How the examiner will test in the examination in this regard, I am bringing a particular problem from our workbook is as follows. which is interpretation. Rule number 13 talks about interpretation for the value of imported goods rules. Rule number 3 talks about interpretation rule. Rule number 13 also be here involved to interpret for arriving the value. Let us take this into account. Example from our workbook. These and all available in the workbook, sir. Very clear. Reading the question here with regard to rule number 7, deductive value concept purpose. A Limited sell in India from a price list which grants favorable unit prices for purchases made in larger quantities. Sale quantity 1 to 10 units, unit price in rupees exclusive of duties and taxes 100 rupees. Number of sales 10 sales of 5 units, 5 sales of the 3 units. 11 to 25 range of unit, selling price 95, sale of number 5 sale of 11 units. Over 25 units sale quantity, unit price in rupees 90, number of sales 1 sale of 30 units, 1 sale of 50 units. Selling price includes the following post shipment expenses: freight from port to factory in India for 24,000, insurance to cover transit damage from port to factory in India 6,000, number of units imported from high seas 5,000 units. Find the assessable value and the total custom duty. Basic custom duty is 12%. So they are asking here total custom duty, my dear friends. When you say total custom duty, you have to find out along with the BCD. BCD along with that social welfare surcharge. What about IGST? IGST, if they given in the problem, then only we are able to apply. At least they have to give the hint. IGST applicable. Enough. No rate not required to provide. By default, we have aware of that at the rate of 18% will be considered. We refer to rule number 55. By default, it will consider as a 18%, 18 IGST. If nothing specified, by saying IGST applicable sufficient. None about IGST. Here there is a none about IGST. I should not presume and assume to apply IGST. Now, in the given case, post shipment expenditure, we are aware of that. We want to know selling price. Sale value we should know. Sale value is not given here directly. Different selling prices are given per unit, which should be considered. Here the range of the sales numbers given. Rule number 13 says, in case of rule number 7, to determine the selling price, first you have to arrive the highest quantity. Here 5 sales, 10 sales into 5 units, 50 units. 5 sales of 3 units, 50 units. Together how much? 65 units. Thereafter 5 sales of 11 units, 55 units. Here 1 sale of 30 units, 30 units, plus 1 sale of 50 units, 50 units. If so, 80 units. So highest among that is what? 80 units. At what selling price? 90. Select it as a selling price. Select. 90 rupees per unit. 90 rupees per unit. We got it, sir. Number of units from high seas, 5,000 units, sir. Then 4,50,000. Correct, Amma? 90 into 5,000 is 4,50,000 is our value, CFL. That itself CFL. I'm not to say that is not CFL, selling price. Selling price. From that deduct post shipment expenditure. What are they? They given here. freight and insurance. So insurance, how much? 6,000. Freight, post shipment, 24,000. Then from that you deduct 6,000 insurance and 24 rupees freight, totally 30,000. You will get 4,20,000. 4,20,000 itself is safe value, because post shipment, no, it is sale price means after adding all this you have the full value. From that post shipment deduct, balance is of safe value, is a value of import goods, 4,20,000 from high seas. If so, on 4,20,000 apply BCD, only one rate is given, 12%. 12% of our BCD, which is equal to 50,400, correct amma? 4,20,000 into 12%, 50,400. That is BCD. Plus you have to add social welfare surcharge, which is 10% of that BCD, namely 5,040. So total amount of custom duty, here they ask, no, total custom duty. Total custom duty is equal to these two figures. That means 50,400 by adding 5,040 SWS, social welfare surcharge, which is equal to here 55,440 is the total duty of customs. Is the way in which you have to identify 55,440. In the case of what we can call high seas purchases, where import takes place, the assessment will be as per rule number 7. Read with rule number 13 of the valuation of imported goods rules. If that is not work out, it is not high sea purchaser, then refer in that case our rule number 8, computed value. What do you mean by computed value, sir? Here, computed value, rule number 8, where the computed value is whole good in the case where exporter and importer are closely associated with each other and the exporter discloses the true and fair manner about his costing to produce that product with his profit. That take into account in India, add the pre-shipment expenditure up to the place of landing in India, that expenditure pre-shipment should add, and finally arrive the value which is computed value as per rule number 8. If that is difficult, the disclosure of costings not made by the exporter properly, in that case valuation will directly goes to into the hands of the department officer of customs. Rule number 9, they are using their best of knowledge and arrive the value and demand to pay the duty on such value. You have any objection, pay the duty under protest, go for appeal. Otherwise pay duty and clear the goods. Rule number 9 is the ultimate, which is not a first choice, first transaction value. If not identical goods, if not similar goods, if not directive value, if not computed value, finally if not, then go to rule number 9, where the valuation will be done by the department using their best of knowledge. Now the point here is, even under rule number 9, department going to arrive the value, they will have to have a basis of valuation, for which definitely they will take the help of rule number 10. Help of rule number 10 they will take into picture. Rule number 10 here, what we can call here is, I'm going to bring, see, for the entire rules here, rule number 10 is helpful. Rule number 10 helpful to rule number 9, rule number 8, rule number 4, rule number 7, 4, 5 and 6 is a commonly providing information. Pre-shipment, rule number 10. Cost of pre-shipment, arrive accordingly. Post-shipment, do not add. Unless the post-shipment is a precondition for import, is the way in which rule number 10 speaks. Detailed discussion on the rule number 10 is as follows. How to consider the rule number 10 expenditure? My dear friends, when the goods are imported, there may be a FOB value, there may be CAF value. How to arrive the value in that case? Rule number 10 says, you please consider FOB value of exporter. FOB value of exporter. How to arrive this? The cost of material, X factory price, the price at which the exporter factory available, plus the handling charges of the exporter country up to the point of loading the goods on board of the exporter country port, transportation, loading, unloading, insurance of the exporter country port till the point of the goods loading into the vessel is incurred by the exporter. From importer point of view, is a free on board. Who's free on board? Exporter incur the expenditure. From the importer point of view, FOB, free on board of exporter. Okay, free on board of exporter is not available. You have to arrive the value. Arrived, sir. To that value, rule number 10, sub number 1 expenditure. Rule number 10, sub number 1 expenditure as a pre-shipment add. What are they? Commission, brokerage. Which commission? Brokerage, sales commission or commission is addable, but buying commission should not be added. Buying commission nothing but bulk discount. More purchases, discount will be given. Less purchases, no discount. So buying commission alone should not be considered while arriving the value of imported goods. Further, packing cost. Packing comes into picture. We have different packing, primary packing, secondary packing, special packing, addable, but durable packing should not add, which is container packing, should not be considered in the valuation. Cost of engineering, sketches, development undertaken outside India alone should be considered as form part of the cost of imported goods. Royalties, license fee, which is paid by the importer to the exporter for import of that goods and selling in India, is also be pre-shipment expenditure add in the rule number 10(1) expenditure. Value of subsequent sale in India, sharing with the exporter by the importer, that value should add. Value of material supplied freely by the importer to the exporter before importation, that value of material should be add and arrive the value. That value is nothing but what you know, my dear friends. It is FOB value of customs. FOB value of customs. FOB value of customs. Once you arrive the FOB value of the customs, after adding rule number 10(1) expenditure, come to rule number 10(2) expenditure. Rule number 10(2) expenditure. If you refer here, rule number 10(2) expenditure, this, rule number 10(2) expenditure. Freight, if given, sea freight, actuals. Air freight, which should not be exceed 20% of the FOB value of the customs. If it is exceeded, the actuals are 20% of the FOB value. Whichever is less should be considered. That means actual air freight should not go beyond 20% of the FOB value of customs. If nothing is given, apply 20% on the FOB value of customs. Do not apply freight 20% on FOB value of exporter. It should be export should not be considered. FOB value of customs should be considered. How the FOB value of customs comes into picture? After adding FOB value of exporter, rule number 10(1) expenditure, you will get FOB value of customs. On that value, you apply 20%. Sir, insurance at the rate of 1.125%. At the rate of 1.125% on FOB value of customs. Sir, ship demurrages, which is pre-shipment, form part of rule number 10(2) expenditure, not rule number 10(1) expenditure. Sir, what about letterage or bar charges? letterage or bar charges, meaning thereby when you talk about here, I will show you a clip here, letterage and bar charges. Clarity I will provide here. When you talk about, my dear friends, import of goods in a particular big vessel, which is called as mother vessel, is a very big vessel, mother vessel, cannot able to come nearby port, too difficult for them to reach, too difficult to come to the port, because very big voluminous. Small vessels we call as transshippers, going to nearby mother vessel, showing the boat note. Part by part, goods are unloading into that particular vessel and bringing to the port for further unloading. The transshipment of this from here to here, this particular vessel going from here, then here, and coming to here, that expenditure is called as letterage or bar charges, which is also pre-shipment. Like a ship demurrages is a pre-shipment expenditure, should add in the value of imported goods under rule number 10.2 to arrive CIF value, which is the assessable value to pay import duty on imported goods. If you are able to understand this much, rule number 10 is in your hands. If that is the case, let's take into account a comprehensive problem in this regard to address this issue from our workbook. I am talking about directly comprehensive problem, not a simple problem. There are so many simple problems are available here and there. I am not going to consider that. Directly a comprehensive problem, which has valuation followed by computation of custom duties. Yes. See, so many times it appeared in the examination. RTP also so many times appeared. Also appeared examination. Is an examination question, my dear friend. I am now going to consider this for reading. Reading as follows. Compute the assessable value and total custom duty payable under the Customs Act 1962 for an imported machine based on the following information. Cost of machine at the factory of the exporter, $20,000. Transport charges from the factory of exporter to the port for shipment, $800. Handling charges paid for loading the machine in the ship, $50. Buying commission paid by the importer is $100. Letterage charges paid by the importer, $200. Freight incurred from port of entry to inland container depot, $1,000. Ship demurrage charges, $400. Freight charges from exporting country to India, $5,000. Date of bill of entry, 20th March, BCD 20%, exchange rate notified by the CBIC, 60 rupees per dollar. Date of entry inwards, 25th February, exchange rate is 65 rupees per dollar, BCD 12%. IGST payable under Section 3, Section 7 of the Customs Tariff Act 1975, 12%. Social welfare surcharge, 10% is applicable. Also find the eligible input tax rate to the importer. That is, from the customs, they are looking into the GST. What is the value of IGST qualify for ITC? IGST only qualify for ITC. How to answer this? Very, very simple, my dear friends. In the given problem, FOB value of exporter itself not given. I have to arrive it. So, this $20 plus Transport charges from the factory of exporter to the port of shipment, $800. Handling charges, $50. These three, sum of the summation is nothing but FOB value of exporter. FOB value of exporter. Which is nothing but USD 20,850. FOB of exporter. I have to add rule number 10, sub number 1 expenditure to arrive the FOB value of customs. Now, in that process, I am considering further buying commission should not be considered. Literage charges paid. It is what type of expenditure? Rule number 10 to expenditure. Literage bar charges. Therefore, I want rule number 10(1) expenditure. Here, freight incurred from the port of entry to inland container depot means what? After importation, completion, this expenditure incurred. Therefore, post shipment should not be considered. Ship demurrages. Rule number 10 to expenditure. Freight charges from port exporting country to India is a pre-shipment. Rule number 10 to expenditure. So as a whole, in the given case, rule number 10(1) expenditure is nil. Resultantly, FOB value of exporter will become FOB value of customs. FOB of customs. USD it is there. 20,000 to 850. FOB value of customs. Once we got it, add to that rule number 10 to expenditure. What are they? Just now I said no. Here 200. Thereafter ship demurrages 400. Thereafter freight 5,000. Here silent killer. Insurance not given. In that case, you have to add insurance, without which you cannot get what? CIF value. So for insurance purpose, tell me insurance purpose, what rate? At the rate of 1.125%. Are you there? Are you hearing me? No respond at all, my dear friends. At least, okay. That response also be not going to give, sir. What a bad communication, semi-qualified, chartered account, cost accountants you people are having. I am telling you, really, I will question as your friend indeed, and also in need. Your approach should be changed. Proper communication should be there, Aya, I am sending you people today class by 6:15. Somebody no response. One gentleman, okay sir, I am very happy to note. At least some response. A communication passing through internet, whether reached my students or not, I do not know. Sometimes double tick may not going to come in the WhatsApp when I send, and no response. What is this? If I am coming, sir, to your place, sir, vanakkam, sir, I said. As a human being, we should say vanakkam. Yes or no? Yes. If so, you are a good person. Not that you get angry at the other person not to respond. You do not know to respond. This is what the communication must be there. Either way, not that always you have to be positively communicate. Your way of expressions. For an action, there must be reaction. Always action decided, no reaction from your side. At least, next, sir. That should be respond, Maya. That is a basic concept, my dear sir. At least not every time, occasionally, in between. Even I am asking also not responding, what I can do. Sir, tell me, in the given case, insurance not given. Silent killer. We have to arrive it by inverting rule number 10, sub number 2, where at the rate of 1.125% is prescribed. If 1.125% on what value? At least tell me, my dear friends, on what value? FOB value of customs, FOB value of exporter. On FOB value of exporter, FOB value of customs. FOB value of customs. Here, fortunately, unfortunately, both are one and same. Since rule number 10, one expenditure is not there. No. Here, multiply on what? On 20,850 EST. So, 20,850 multiply with 1.125%, which comes here almost all 234.5625, because it is dollars, my dear. It is in dollars. 4 digits to be maintained. 4 digits after decimal, 4 digits you have to maintain. Should not round off for the God's sake. Yeah. Now we got it. Here, these are the values. This value, this value, this value, this value, this value is equal to our CIF value. How much comes here? 20,850 plus $200 of letterage plus the $400 of ship demurrages, $400 ship demurrages. Thereafter, freight $5,000. Insurance is 234.5625. Totally, we got here CF value in USD 26,684.5625. $26,684.5625 is the US dollars, our CF value. Multiply in Indian rupees. Exchange rate of the CBIC. Only CBIC exchange rate. But if I refer here, there are 2 exchange rates are there on 2 different dates. On which date exchange rate should be considered? Bill of entry. No. Try to understand. That's why you spell out wrongly. I will take you as my best friend to correct you. That's what I'm saying. You spell out. It is incorrect. My dear, BCD, to determine the BCD, bill of entry date or entry invoice granted to the conveyance. Among the two, whichever is later should be considered. Exchange rate is considered CBIC exchange rate only at the time of submission of bill of entry. That's it. Do not take whichever is later. Generally, students community will commit the mistake here. I know that. Knowingly, I am highlighting you, speak out. Then we come to know what is our, when you express only, we should know what is correct, what is incorrect. That doesn't mean that, oh, tappu sunnane, and shy, not required. You pride yourself, yes, I am learning the right thing. You have to take that spirit. Always, that spirit is required. Attending twice the classes. Sir, I already attend the classes. Again, I want to attend. You most welcome to attend the class. Sir, another what attend tapa? Revision, no. Revision, no. Then, thappe kare. So, like that, you should be, see, once you qualify, no one will ask you to write the examination for the lifetime. It's the highest examination, that's all. There's no further examination to test your knowledge in indirect taxes. Once you qualify the CA or CMA final. Now, please come back and look here, my dear. The exchange rate is considered only the exchange rate of the CBIC at the time of submission of bill of entry. Bill of entry, submission exchange rate, bill of entry. Therefore, it is 60 rupees. Multiply here with the 60 rupees. you get CIF value in Indian rupees. Multiply with 60, which is 074. I can yes, 16 lakh 1074. Round off. Indian rupees round off nearest to 1 rupee. If you have considered all the points correct, my CF value is correct. My CF value is correct, my duty of customs also become correct. If the CF value incorrect, duty of customs also incorrect. So it's a flow of a interlinking. Let us compare with the solution. 16 lakh 1074. How much we got here? 16 lakhs 1074. So far so good. Correct. Now, having this, you have to mention the bill of entry, the CAF value in the foreign currency, CAF value in the Indian currency. Both you have to mention in the bill of entry. Thereafter, in the bill of entry, you have to mention what the duties of customs. First, BCD. You have to apply BCD. BCD they given here. There are two rates are given. 20% date of bill of entry and a date of entry inwards 12%. Here only you have to rightly approach and say date of bill of entry, date of entry inwards. Among the two, whichever is later, that is called taxable event. As per the Garden Silk Mills Limited, Supreme Court of India said the taxable event for imported goods is at the time of crossing the customs barrier. That means I told you, no, I shown you a check post. That fellow is bringing goods from port and check post, goods verified and bill of entry verified. Chod dere means vadilayandi, uttungo. So leave it. Then that fellow cross that particular barrier is called that point. To reach that goods, that point, two things should take place. Date of submission of bill of entry might have been taken place and entry inwards granted to the conveyance also be taken place. Among the two, whichever is later, both the things will be taken place. Which is later here? Bill of entry is submitted when? 20th of March. Entry inwards 25th of March. Which is later? Which is later? Oh, 25th of February. Sorry, repeating. Date of bill of entry 20th March. Date of what we can call it, entry inwards 25th February. 20th March, 25th February. Which is later? 20th March. Be careful. So 20% applicable. So 20% BCD. BCD 20% on this value. Therefore, 20%, which comes into excellent 3,20,215. So add SWS 10% on BCD, which is 32,222. I can say round off 32,022 rupees. Then your CA value plus your BCD, your SWS, total you have to add. For what purpose? For your IGST purpose. So 16 lakh 1074 plus 3 lakh 20,215 plus 32,022. Total put together is equal to your transaction value for IGST purpose. Transaction, how much value comes here total, which is 19 lakh 53,301. 311 can you consider? 311 amma. 301. What are they? Check and tell me. 19 lakh 53,311. Means round off. If so, IGST. At what rate here given? IGST given in the problem as 12%. Therefore, 12% IGST. On this value equal to 2,34,397. This value is qualified for ITC under GST law on account of import of goods. So 2,34,397 is the IGST. If this is correct, this value is correct, everything is correct, all computation is correct. Let's check here how much IGST will be allowed. IGST 2,34,397. Yes, 3,34,397. 3,34,397. Here we got the value. Same value is the way in which you have to compute. And now please come back. Actually, where we are, my dear, we are referring what? The import procedure. I told you it is a very big one. Import procedure, very lengthy manner we are going to discuss. Import procedure is still not completed, my dear. Import procedure still not completed. Actually, where we are in the submission of bill of entry. Why submit the bill of entry? To clear the goods for home consumption. If the goods clearing for home consumption, for which I am going to submit the white color bill of entry, I should arrive the value of imported goods in the bill of entry, compute the CA value in the foreign currency and Indian rupees by following self-assessment. And I too compute the basic custom duties, social welfare surcharge, other duties of IGST, any other duties should be computed and show in the bill of entry, submit. If the department satisfied and return back to me the bill of entry to pay duty, I have to pay on the same day, the day on which they return back the bill of entry. If not, for the number of days delay minus holidays, for the balance number of days, I have to pay interest at the rate of dash percentage per annum. Speak out. 15%. Still, the import process is not completed. Why? Because there may be a possibility the importer can able to submit bill of entry, yellow color, stating that I want to warehouse the goods, I want to defer the payment of import duty into the future period. Yes, you are allowed. If the goods are worthy to warehouse, it is going to be decided by the Assistant Commissioner, Deputy Commissioner by seeing your application, namely yellow color bill of entry. You want to warehouse the goods, fine, your goods fit for warehousing, permission granted to warehouse, then the goods are warehoused. If the goods are warehoused, at a later date, I am going to clear the goods from warehouse for my home consumption by submission of green color bill of entry. At the time of submission of yellow color bill of entry, the department may ask you to execute a bond thrice the amount of the duty. Thrice the amount of duty, bond executed, and under the bond the goods are warehoused, where the duty of import deferred in the future period. Tomorrow, when I am going to clear the goods from the warehouse, I have to submit X bond bill of entry, which is green color bill of entry. That time the taxable event arises to pay the import duty in the case of warehouse goods clearing for home consumption. That time only taxable event arises in the case of warehouse goods. If that is the case, what rate of duty have to pay? The rate of duty prevailed at the time of clearing the goods from the warehouse. Is it so? Yes. At the time of clearing the goods from the warehouse for home consumption. Simple. When you're going to submit X bond bill of entry, also be called as sub bond bill of entry, also be called as green color bill of entry. When you're going to submit, that time taxable event arises as on the date, rate of duty of BCD, IGST will apply to pay. If it is more than 90 days you kept in the warehouse, from 91 day onwards, till the rate of clearances, you are liable to pay interest at the rate of 15% per annum. If I did so, my import procedure is completed at that level. Then what about assessment? Assessment should be completed at the time of import, at the time of execution of mother bill of entry, namely yellow color bill of entry. That time you have to arrive the value of CA value in the Indian rupees and foreign currency. That should be shown in the bill of entry. That is unaltered. What is going to be altered? The duty amount is shown in the bill of entry, mother bill of entry, that may be deviate at the time of you clear the goods from the warehouse for home consumption. That time rate of duty is the taxable event. Therefore, that time whatever duty prevailed on the value which you already arrived, CF value, there is unaltered. On that you have to apply BCD, what is applicable at the time of clearing the goods from the warehouse for home consumption. That rate applicable. Don't worry, we have warehousing chapter separately. There I will refer this particular computations, applications. With this, I can say that at this point of time, my import procedure is completed, which is revising as follows. First, vessel arrives the custom station in India, submit arrival manifest by the master of the vessel, namely person in charge. Entry invoice granted to the conveyance by the customs on the based on the arrival manifest, and loading of the goods can be takes place thereafter. Thereafter, submit the bill of entry by the importer to clear the goods for home consumption or to clear the goods for warehousing, as the case may be. If pay the duty and clearing the goods once cleared into DTA, domestic tariff area, no longer called import goods, because import gets completed when the goods cross customs barrier. As simple as this is called as import procedure. In nutshell, practical manner, I try to present import procedure. At this point of time, I am concluding session. Continuation by tomorrow at 6 a.m. Thank you, my dear friends. Have a good day. Welcome, Mama.